Welcome everyone to tonight's Hookup with Real Estate Masterclass. We're super excited. We have our special guest, Yonah Weiss, who I'll be introducing in just a minute. And he's going to be talking on cost segregation. What is the next slide?
Oh. Hello, everybody.
Hey, Jeff. Can you read the disclaimer, please?
Yes. We appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice. Nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hookup with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you. All right, so I'm Donna, that's Ken. We are Hookup with Real Estate. Our mission is to empower aspiring and early real estate investors with exceptional education, invaluable skills training, and genuine opportunities to invest in real estate, while simultaneously sharing strategies that guide you towards success in real estate and away from costly mistakes like we made early on in our real estate journey, which you can read about here in the book, Real Women in Real Estate. It's on Amazon, or I can send a signed copy. Okay, just briefly, my husband is a licensed realtor in New Jersey. He's also a veteran and a tile contractor, amongst other things. We also own real estate, so he's an investor as well. All right, moving on. What is this thing? We are powered by Legends Equity Group, and this is the leader of the group, Alex Lovely, and they run a free stages call, not every Monday, but some Mondays in the Legends community. They're having a breakthrough event in January 8 through 10 in Las Vegas, and I just went to the one they had in Salt Lake City, and it was phenomenal. It's not really about real estate, but it's about breaking through, and I highly recommend it. Okay, they also run a free education on their school community, school.com/real estate club, and there's some free training out there. There's also a great community out there, so if you have questions, you can ask people. We also recommend something called Core Tax Deeds, and you can find it at invest.coretaxdeeds.com. Their raise, which is very affordable, is ending on April 5th of next year. So I can't say more legally because it's a crowd-funded tax platform, but they just raised a whole bunch of money, and they're doing well. So here we are. This is our calendar. We're in August. This master class and 4 more after here. Note that November and December are alternate weeks. We normally meet on the 4th Wednesday, but due to holidays, we move them to the 3rd. All right. There are 2 ways that you can connect with us, really more, but for the replays, you'll find them on YouTube at Hookup with Real Estate, all one word, or you can join our Facebook group, and you can join our Facebook group at Hookup with Real Estate. Now, if you're relatively new to real estate and you want to find out more and you can take next steps with us, we'll give you real guidance, real strategies, and real investment opportunities. We can have a free call. Ken, please read the quote of the day.
Always walk through life as if you have something new to learn, and you will. Vernon Howard.
Thank you. Now we get to the really good stuff. I get to introduce our special guest. So Yonah Weiss is a powerhouse with property owners' tax savings. As business director at Madison Specs, a national cost segregation leader, he assists clients in saving over $1 billion on taxes through this cost segregation strategy and process. Yona has a background in teaching and a passion for real estate and helping others. He's a real estate investor himself and host of a top podcast called Weiss Advice. Yona is also the creator of the Commercial Real Estate LinkedIn Challenge, a powerful online event that brings together many real estate professionals for 2-week sprints of LinkedIn posting. Through his challenge, you gain an opportunity for deep connections. In fact, I am personally very grateful to Yona because several of the guests we've had here on our Hookup with Real Estate podcast have come through connections I've made during his LinkedIn challenge. Now, today, we're very excited for Yona to share an incredible way for real estate investors to save on taxes. So please help me welcome Yonah Weiss as he shares his insights on cost segregation, the legal tax hack every real estate investor needs to know.
Thank you so much for that introduction. I'm grateful to be here and really happy to hear that, the 10-day LinkedIn challenge I do obviously is I've been doing it for years now, every few months. And it's always amazing to hear when you have real connections that are made, leads to major, I've seen many times lead to real business partnerships, investments together, deals, but even interview podcasts. It's just incredible. So I appreciate you guys inviting me out here, and happy to talk about a subject that most people think is really difficult to understand. But tonight, hopefully, our goal is to make it as simple for everyone that when someone asks you what's cost segregation, you'll be able to answer in a sentence or two. And that's really my goal.
All right, fantastic. But before we talk about cost segregation, we always like to ask the question, how did you get started in real estate?
Well, I was a teacher, as you mentioned in the introduction, for about 15 years, and I was having a hard time making ends meet, just to be as blunt as possible there. And with student, debt and all kinds of growing family, I have 6 kids, and it was very difficult, to be honest. So I figured, I need to make a change. I need to find something else to do. I asked around to a bunch of different friends and acquaintances, and real estate kept coming up in conversation. I was open, really to anything, just a new opportunity. I wasn't really into or looking to go back to school to learn like a different trade or something. So I was looking for something that, number one, didn't require me to have any extra formal education. I had spent a long time in formal education prior to that. And number two, something that had a potential to make, a lot of money. Well, real estate kept coming up. I started out in real estate as a commercial mortgage broker. It's really how I got my first kind of forte into the industry, just learning the trade, everything there was to know about commercial real estate. I worked together with a good friend of mine, basically side by side in his office for about 8-9 months. And then we did some fix and flips together. I got my broker's license, residential real estate. I was just kind of learning everything there was to know about real estate, did some hard money loans. And then an opportunity came this was about 8 years ago, to work with this company, Madison Commercial Real Estate, Madison Specs, the biggest national cost segregation company. I didn't know at that time what cost segregation was. And to my surprise, neither did anyone else that I spoke to, right? And I was like, what is this thing? But I heard very good things about the company. I knew some other people that had been involved, a very well-respected company. And I took the opportunity. It was a new opportunity and I was open to it. I was still doing other things in real estate, but decided, let's try this out. And it turned out they were looking for someone to help run the business development. And what I learned very quickly was that it was basically education, because the main reason why people don't do cost segregation, and even to this day, is simply they don't know about it or they don't understand it. Because once you learn about what it is, it's basically a no-brainer. It's either it totally makes sense or it doesn't for my situation. But it's really quickly decision once you know what it is and how it works. And so that's really been what I've been doing for the past 8 years or so, is just educating people. And thank God through that we've helped thousands of investors save billions of dollars in taxes.
It's awesome. So we're ready for you to educate us. Do you mind if people ask questions along the way? Or
Absolutely. Of course, I
Okay.
would love for people to ask questions. Would you prefer me to just to do kind of question answer, or would you like me to have a PowerPoint kind of run through some
yeah,
slides?
you had the PowerPoint. That would be great.
Sure. Yeah, let me just bring that up here. I thought I did bring it up before, but
You should be able to share your. So yeah, helping
yeah,
billions of people
absolutely.
save on taxes is pretty awesome. I mean, you can feel really
Well, not
good
billions
about
of
that.
people yet, but
Or I mean, billions in dollars worth. Okay.
yeah, love to help billions of people, but I can't use this and scroll at the same time. I forgot. It's just on Zoom. Or maybe I can actually. Let's see. Um, slideshow from the beginning. Whoa, what happened there? Okay, there we go. So this is what I like to call unlocking hidden wealth. But yes, if you do have questions, please bring them up. Please stop me. I tend to not act, speak a little fast sometimes. So make sure to stop me. So we're just going to go through the different topics. What is, as I mentioned, at the end of this presentation, you'll know in a quick sentence or two what is cost segregation and how to answer that. We'll see what are the benefits of doing it, what's bonus depreciation, are they the same thing, who should be doing this, when is the best time, what's a real estate professional. This is probably the most important question on this in this performance and in this slide, and we'll see why that is. The different asset classes, property types, etc., that can be used. I do have a case study. I don't know if we'll have time for it, but we'll walk through the numbers as we go along as well. So the first thing we need to understand when we're talking about cost segregation is depreciation. Okay, depreciation, because cost seg is just an advanced form of depreciation. So in a nutshell, what cost segregation is, well, again, let's take a step back. Depreciation. Anytime you buy a property besides for your primary residence, the IRS allows you to take this deduction called depreciation. It doesn't mean that your property is going down in value. It doesn't mean that at all. It's just a borrowed term. And so what we're doing is taking this deduction as if the property was going down in value. And the IRS gives it an arbitrary number of either 39 years for commercial properties or 27.5 years for residential properties, including multifamily. That being said, there's actually a way to break down the property further into different categories or different components that depreciate on a faster rate, which essentially allows you to take bigger tax deductions during the earlier years of ownership. And in a nutshell, that's what cost segregation is. So if you want to answer the question, what is cost seg? It's a cash flow mechanism that allows you to take bigger tax deductions during the earlier years of ownership. Okay, that's it. It's taking from a pool of potential deductions and bringing them forward so you can take them in the first year or in the first few years. So again, we'll go through all the steps of what this means and how we do this. So let's take an example. Let's say you buy a property for $1 million. Okay, there's always going to be a land allocation. Land itself does not depreciate. So we're going to take off, let's say 15%. That's the national average. There's certain locations, and location is probably the biggest factor when it comes to land value. There are certain locations like California, for example, where it's very common to have upwards of 50% land value, or beachfront properties, et cetera. But most places are around 10 to 20%, 50% average. So our depreciable basis, this means the amount that we can depreciate is going to be $850,000. And this is going to be specific to properties, but this is just an example. Now, let's say you took what's called straight line depreciation. Straight line depreciation is what every accountant knows. You buy a property, you divide it by 27.5 or 39 years, right, after taking off the land. So for commercial property, you're going to get a $21,000 deduction. Residential, $31,000 deduction. So that means you buy $1 million property, you get to take a tax deduction of $30,000. That's it. I mean, it's as simple as that. Now, the main thing to remember here, and we'll get to this later more when we talk about the real estate professional status, is that this deduction, this $30,000, helps reduce your taxable income. Now, if you have a property, let's say it's a 5 cap and you're making $50,000 of net operating income from this $1 million property, that means that you are reducing your tax liability by $30,000. You're only going to be taxed at $20,000. Okay, it's simple math, right? So far, so good. Again, ask questions if I'm going too fast or anything's not clear. Now, what cost seg is going to do is we're going to identify certain components that depreciate at a faster rate. And so we're able to take bigger deductions during the earlier years. And so let's take an example. Let's say in this $1 million property, we're able to take out, 100, let's say 20% of that is going to go into the 5-year category. And we're going to describe in the next slide what this 5-year category is, but essentially personal property like appliances, fixtures, furniture, stuff like that. That's $170,000 right there. Then 15-year property, this is land improvements, another 8% of the total value, another $68,000. So this is going to get you $238,000. And with 100% bonus depreciation, allows you to take that full deduction in the first year. So let's say, again, you buy this property for $1 million. Instead of a $30,000 deduction, you get a $238,000 deduction in the first year. So that's really the power of what cost segregation is and why so many people use it, because it basically supercharges your tax deductions, helps you to reduce your tax liability, like I said, a cash flow mechanism, because everyone knows that the number one expense that every individual or business has is taxes. So if you can reduce that, then you can have that money to reinvest, help grow your wealth, etc. And we will get to later on again who can use this and how much of this 238,000 in this example can actually be applied to your income and to whose income, et cetera. So again, we will get to that shortly. Now, how does it work? Like, what are the mechanics? It is an engineer-based study, which means the IRS requires that an engineer actually come to the property, either physically or with the help of technology. Nowadays, we can do it through a video call, similar to what we're doing now, right? You can take your phone and kind of show me around your property, and we'll record it that way. Identify the different components, as I mentioned. And it actually used to be called component depreciation instead of cost segregation, which makes a lot more sense. We're going to identify those components, put them on different schedules, and create these deductions. Now, I mentioned we'll talk about in the next slide, what are these different things? So when it comes to depreciation, there's basically 4 categories. Number 1 is the land. We mentioned land does not depreciate. Okay. The second thing is the structure. The structure is always, or in most cases, going to be the main value of every property. And that is really the only thing that depreciates on the 27.5-year or 39-year schedule. So the structure can be, the roof, walls, doors, windows, foundation, infrastructure, things like that, things that are necessary and essential to the property. These 2 other categories here are what we call 5-year property, which is tangible or personal property. And this can include anything inside that is non-essential to the structure. So you can have stuff, not just like furniture and appliances and fixtures, but even stuff like flooring, cabinets, countertops, millwork, window treatments, all kinds of things like that, where you may not think of it as, personal or tangible, movable property, but it actually, from the tax perspective, the IRS does consider it as such. And so you can take all these deductions of those components over a 5-year period. The 15-year is land improvements. So we'll refer back to this all the time. It's like 5-year property, 15-year property, and this is what we mean. Okay, the 5-year is personal property, 15-year is land improvements. The land doesn't depreciate, but what's on top of the land does. So pavement, concrete, landscaping, fencing, if there's a swimming pool, if there's a playground, anything like that. So you'll have very common on a multifamily property, you'll have a parking lot, you'll have, pavement, you'll have landscaping, fencing, you may have a retaining wall. All of these things have, and even signage, all of that has a 15-year depreciable value, which means we can take the value of those components as a deduction over a 15-year period, accelerated depreciation, as opposed to that longer 27.5-year. And with
I have a question. Oh, sorry.
No, go for it.
Did tree removals count any of this? Tree removals?
Well, tree removals it's not something that's depreciable. That would sounds more like a business expense. right?
Oh, but if you're improving the land to like build the parking lot, you have to
Yeah,
remove
well,
trees.
yeah. I mean, that is building the parking lot. Any money spent on the actual fixed asset is going to be depreciable, right?
Okay,
But taking something out, yes, the tree may have had value before, and now by removing that, you can actually write it off, write
okay.
the value of that tree off because it's no longer depreciable. So that's a good point. So yeah, really any improvements to land. And when I talk about land improvements, this doesn't mean that you have to do the improvements yourself. What this means is when you buy a property, it includes everything in it. And so instead of saying we're going to take that, $1 million property and just lump it all together and put it on a 27 and a half year, we're going to take that $1 million property and the engineer is going to identify as is at the time of purchase how much pavement is there in the parking lot, how many trees are there, how much landscaping is there, and identify those and then apply value to them and then take those deductions. However, if you do, and we'll get to this a little bit later, if you do improvements, if you do renovations, if you do major capex, that's on top of what we've already done with the cost seg. And so you may be able to take even more deductions after that, but that's really a second stage of the depreciation as opposed to the first stage, which is just taking the acquisition and identifying, how much depreciable value for each component is there. Okay, so again, this is what we're talking about. Cost seg, we're breaking down the property into the from the structure to breaking out the 5-year, the 15-year, and taking those deductions. And I was about to say earlier is that both these 5 and 15-year are eligible for 100% bonus depreciation, which allows you to take all of these deductions in the first year as opposed to the 5 and the 15-year schedules. And we'll talk more in detail about that shortly.
I got a few questions if it's okay.
Absolutely, Stephen. And I may not answer them right now because they may be coming in the coming slides, but ask away.
Okay, so wait, what, Donna?
Yeah, just to clarify, it's Stefan, but go ahead.
Oh, Stefan, my apologies.
Okay, thank you, Donna. All right, so I owned a medical building, and in order for the tenants to sign a new 10-year lease, they wanted $185,000 cosmetic improvements. After they signed that, I then sold the building for a huge profit. And that was January 2024. Most, if not all the expenses were at the end of 2023. So the accountant wrote off, he depreciated minimal. He said, you can't write these off. But going forward, even though I sold the building in 2024, am I eligible for any type of the, there's the structure, the tangible, the 15-year. I won't have it for 15 years. I won't even have it for 5 years. Am I eligible to write anything off am I eligible to write anything off now?
Well, you already sold the property, correct?
Yes, I sold it January 2024.
And you still have yet to file your 2024 taxes, I assume?
That's correct. I did file the extension.
Right. So, which means you will still be able to claim depreciation on your 2024 taxes for that property. However, since you sold the property also in 2024, you'll also in the same year have a capital gain tax. You'll also have what's called a depreciation recapture tax. For any depreciation taken, you're going to be taxed on that amount. So typically, I'll answer the question in two steps. Number one, yes, you can depreciate the property even though you already sold it because you did own it for a period of 2024, and
right.
And any of the improvements that you did, the tenant improvements are considered depreciation as well. You can deduct those and depreciate those. And you could potentially even do a cost seg on it, even though you already sold the property. Since you did have ownership of it, it might be a little complicated to do a cost seg at this point to get an engineer in there if you don't actually own the property. But technically speaking, you could do a cost seg still because you did have ownership of it. However, I typically wouldn't recommend doing that since you have the depreciation recapture tax simultaneously, which means most of the benefit is going to be offset by the gain from that recapture tax that you'll have. So there's going to be very little benefit there of doing it. But technically speaking, you could.
Okay, so you said there's two types of forgive me, there's two types of things I can claim. Depreciation, you said, if I heard you correctly, you said there are two types of depreciation. What were the two that I could take for 2024?
Well, there's the depreciation from the property. You could do the cost segregation, which is what we're talking about tonight, and that would allow you to take, not just the tenant improvements, but the actual whatever was in the property to take those accelerated depreciation. However, there's what's called depreciation recapture tax, which is you're going to be taxed on whatever amount of depreciation taken, and so therefore it typically wouldn't be of your benefit to take all the depreciation and in the same year basically have it taxed, and so there's very little benefit of the deductions left.
Will I get taxed anyway?
Stefan, can we take the personal stuff to later? And
Sure, absolutely.
Yeah, that's fine.
Let's go with the generic. Thank you.
No, it's good. It's great questions, and absolutely learning things from them. But yeah, let's take, maybe we'll get to the personal questions later. And also, I'll provide my contact information if anyone, if we were not able to answer questions tonight, I'll definitely happy to speak with anyone for their individual situations later. So yeah, moving right along. So to recap, I know some people joined a little late. What are the benefits of cost seg? We're reducing our tax liability by creating these bigger deductions during the early years. That increases our cash flow. The time value of money, which, as we're talking to Stefan, the time value of money, paying less taxes now allows me to use my own money to reinvest. That creates compound interest. You can basically grow your wealth at a faster rate. And so this is really what the benefits, that's what it's all about. I know it sounds a little complicated, but simply put, that's really, in the end of the day, what it's all about. So who should be doing this? Really, anyone can do it. It does not matter what type of entity you own, as long as you are taxable. So if you have a nonprofit, and actually had a conversation this morning with an investor who is partnering with a nonprofit to, provide affordable housing, and he's trying to come up with a scenario to structure the deal in a way that he'll be able to claim depreciation, and his partner, which is a nonprofit organization, can't benefit from the depreciation because they're nonprofit, and they won't get any depreciation there. So there's a way to do that, and that also comes up with people who are investing from retirement accounts. Most retirement accounts, which is a great way, if you have a retirement account, an IRA or a 401k, to self-direct that and to be able to use those funds to invest in real estate. However, most of the time those are tax shelters in and of themselves and would not be eligible to use depreciation. There are a couple entities that would, to offset UBIT tax, but without getting into details there, that typically speaking, there's not going to be benefit. But yeah, it doesn't matter if you own it under your personal name, if you own it an LLC, a trust, corporation, etc. Anyone can do it. And really, a business, if you're a business owner, this is something that gets overlooked quite a bit. If someone who owns a business, or someone who is, like, let's say, a doctor or a dentist or an attorney who owns the building where they practice out of, and they may not think of themselves or consider themselves real estate investors, but they can actually do a cost seg because the building itself is eligible for depreciation, as well as someone who owns a business and maybe having like a factory or a manufacturing site or something like that, where that itself is eligible for depreciation. You can do a cost seg on that as well. And that can actually be used to offset the business income as opposed to the individual income if the property is owned by the business. So just a kind of side note there, but important to understand because it gets overlooked quite a bit. Now, I mentioned at the beginning that this slide, this real estate professional status, is probably the most important thing we're going to discuss tonight, because it's like, people say it's not about what you make, it's about what you keep. The truth of the matter is, people are treated differently when it comes to taxation, according to the IRS rules. And this real estate professional status is a prime example of that, because depreciation is considered a passive deduction. which means that real estate, if you own rental properties or you invest passively in real estate, that investment is considered passive income. And there's pretty much no other type of passive income out there, meaning if you have stocks or bonds or anything like that, that's considered portfolio income, not considered passive income. So when we talk about passive income from an IRS standpoint, that's rental income, rental property. Royalties can also fall into that. Or if you have a passive interest in a business ownership, less than 5% ownership in a business, for example, and you don't do anything, that would also be considered passive income. But for our intents and purposes, we're going to be talking about real estate rental income. Now, that being said, if you do a cost seg, that depreciation can only be used to offset your passive, your rental income. You cannot use depreciation to offset or reduce your W-2 income. So if you're a full-time, W-2, you cannot use cost seg. Now, there are a few exceptions to this. We're going to talk about 3 of those exceptions tonight. The first one is on this page, are the most notable exceptions to that rule, which is what's called the real estate professional status. If you or your spouse, if either one of you meets this qualification, then you can use cost seg and depreciation to offset your W-2 or to offset any source of income whatsoever. So this is the first exception to the rule. So the definition is if you or your spouse are full-time in real estate, meaning more than 50% of your working hours during the year is in the real estate trader business, and you have to have a minimum of 750 hours a year materially participating in either the developing, here, this is the actual wording from the IRS, developing, redeveloping, constructing, acquiring, converting, renting, leasing, operating, managing, or brokering real estate. So someone who's a real estate broker or agent, realtor, anyone here, by the way, is say, just put in the chat, yes, if you are a realtor or a broker, real estate agent, because anyone who is a real estate agent or broker automatically qualifies as a real estate professional, which means you can benefit from cost seg and from depreciation as long as you own or invest in rental properties, more so than anyone else out there. So you have this status, you may as well use it. Okay. So this is the first. So someone who is
I
not
have a question about that too.
Yeah.
So is it enough to be a real estate agent? I thought you also had to perform the 750 hours of service.
So it's not enough to be an agent, meaning first of all, you do not need to be a real estate agent or a broker to be a real estate professional. But just being a real estate agent gives you that status. You do, however, still need to put in material participation hours in some actual rental property activity, meaning the ownership, the acquiring or converting, renting, operating, managing real estate. So that's why I mentioned you have this status already, a real estate professional, but you need to actually own real estate in order to benefit from it. So yes.
Okay. And
question.
Felix added a statement that as long as you don't have a full-time job. So
right, meaning, as I said, you need to more than half of your hours need to be in the real estate trader business. So that's the first thing the IRS is going to look at is if you have a full-time job. If you do, then even if you have a license, you cannot be that real estate professional status. But excellent.
So there are 4 realtors here in the call. So hey,
there you go. There you go.
Good.
You already got it. Now you got to invest if you haven't yet, because take advantage of this. So that's the first exception to the rule. Again, if you just have a W-2, you can't use the cost seg. It's just going to help to reduce your passive income. But don't get me wrong, that's great, because investing in real estate, there's basically no other asset class out there that allows you, oil and gas can do that, but that allows you to invest in something, make money, and then not even have to pay taxes on that money being made from real estate because of the cost seg or because of depreciation. So that, it's great in and of itself, but the real benefit comes when you or your spouse can meet that real estate professional status. So that's one example. The second exception is what we call the passive real estate professional, meaning if you make less than $100,000 of adjusted gross income, then you can actually use $25,000 of your depreciation to offset your active W-2 income. Okay, and it phases out up to $150,000. So if you make over $150,000, then you can't use any deductions to offset your W-2. But if you make under 100, it's 25, and then, like I said, it phases out up to 150. So there is some benefit if even if you're not a real estate professional, and you do own real estate, you can use the depreciation if you make less than 100,000. The third exception, which is my favorite one, is called what we like to call the short-term rental loophole. And the loophole is in air quotes because it's not a real loop, it's actually in the tax code. But when they wrote this rule, 30 years ago or something, it was before Airbnb existed and before it became popular to own and operate short-term rentals as much as it has become now today. Now, anyone actually own a short-term rental? Write yes or write STR in the chat if anyone here owns a short-term rental, because this is an amazing opportunity to take advantage of cost saving and bonus depreciation, even if you're not a full-time real estate professional. And so see Hudson, Alfred owns a STR. That's amazing. You can benefit from this. So essentially, the rule is like this. If the average stay is less than 7 days, so it's an official, short-term rental, it's not midterm, and you materially participate, and so there are two qualifications. Either you spend 500 hours on your property, materially participating, managing it, renting it, self-managing it. Again, the main thing is you have to self-manage. Oh, very cool. A cannabis lease location in Fresno. So either 500 hours, and that can include grouping together multiple properties, or you spend 100 hours and more time than any other individual. And so I've seen many people own short-term rentals, operate them, self-manage them, even remotely, still have a full-time W-2 job. And because of that, you're able to use the cost seg and use depreciation to offset your W-2 income. Okay, this is a special rule with regard to short-term rentals, because what happens is the IRS treats it like an active business, an active property, and therefore it becomes active income. And therefore you can use the depreciation to offset not just that active income, but any other income as well. And so that's really the power. The reason why this is my favorite is because, many people who are very busy professionals want to invest in real estate to reduce their taxable income, but they can't, meaning they don't get the benefit because they're not a full-time real estate professional. This is something that you can still have your job, right? A lot of people don't want to quit their jobs. They enjoy what they do. They enjoy working and just want to invest in real estate to lower their taxes. This is really the solution. And I've seen many people, hundreds of people, literally, who have been able to, either reduce their tax liability to zero, or several people that I know personally that have literally been able to retire because, they're able to make more money after taxes by just managing a few short-term rentals than they were, in a full-time job. So very, very powerful. Awesome. So moving, any questions on those? So yeah, Hudson, you definitely check out this thing over here with your short-term rental. May be a great opportunity there. So let's talk about the Tax Cuts and Jobs Act of 2017. And I realize that I did not update this. I probably should. I don't know if I can't do it while I'm, I can't do it while I'm presenting, but I forgot to make an update in this from the last time I presented this slideshow a month ago. But what happened in Tax Cuts and Jobs Act was it introduced this thing called 100% bonus depreciation. And what that said was, once we've identified through a cost seg anything that depreciates faster, right? Your 5-year property, your 15-year property, who remembers what that is? The 5-year, the personal property, the 15-year, the land improvements. Once you've identified that, we can take the 100% of those deductions in the first year. So if you bought a property between, sorry, someone, a question, or just someone?
No, it was just some weird noise I heard.
Yeah, everyone, you got to remember to mute yourselves. So what happens is, once you do the costing, you take that. If you bought a property between September 27th, 2017 and January 1st, 2023, you're able to claim 100% bonus depreciation. If you bought a property in the year 2023, it went down to 80%. In 2024, it went down to 60%. And at the beginning of 2025, it went down to 40%, which means you could take 40% of those accelerated deductions in the first year. I say here there's talk of it getting reverted. Like I said, I forgot to update this. It was reverted. There was the big, beautiful bill that passed last month, which reinstituted 100% bonus depreciation from January 20th, 2025, going forward permanently. So unfortunately, if you bought a property or placed in service a property in the beginning of January, it's still only, you can take 40% bonus depreciation. But anytime after that and going forward, it's become permanent that you can take 100% bonus depreciation. Okay, so that's really important. That means that, getting those big tax deductions is really back on the table as it was a few years ago. So really exciting. And I mentioned the reason why it's important to know when the property was placed in service is because you can do a cost seg even on a property that you owned a few years ago and never did one, but you do it this year. And the bonus depreciation percentage amount goes based on when that property was placed in service. So if you bought a property back in 2022, never did a cost seg, and want to do one this year, you can. You don't need to amend your tax returns, and you can claim 100% bonus because, again, it goes based on the year that it was placed on service, which that year was a 100% bonus year. Okay.
Wow.
Moving right along. Looks like we're covering ground here tonight. Actually running out of time here. So so when is the best time to do it? I just mentioned that you can do this on a property that you purchased in a previous year. We call that a look back study, which again allows you to look back and basically catch up the missed depreciation. The best time to do it really is when you can use it the most, because it is a tax strategy. Most people like to get it done in the first year of ownership because, set up things the proper way from the beginning. However, if you don't have a tax liability, let's say, you buy a property and it's not making any money, or you don't have any reason to do the costing, you don't need to. So again, you can do it when it's best for you. You can do it after you a renovation. A new construction property, obviously you can do a cost seg as well. But the renovation gets a little bit tricky because the timing of the renovation and the extent of the renovation can actually make a difference of how much or if you can even benefit from the cost seg. So for example, if you buy a property and immediately start to gut it and renovate it, you can't do a cost seg until after the renovation is complete. And at that point, we're only going to be looking at the money spent on the renovation as opposed to the purchase price. Why? Because think about it. Anything that you could have taken as a tax deduction from those, the personal property was basically torn out and was never placed in service. And so depreciation is only a deduction for an asset that you own that is a rental property. And so if it was never in service as a rental until after the renovation is complete, we can now only look at, those components that are now being rented out as in service as a rental. So again, it does get a little bit tricky. So the best way to take advantage of it, to really get the best of both worlds, is buy a property, rent it out, take the cost seg on the original purchase. Again, you can take the purchase price, get all the benefit from the cost seg, and then at a later point, when you do the renovations, you can then take all the money spent on the capex, on the renovations, and depreciate that as well, and basically double dip and take the cost seg on the renovations as well. So there is let's talk about the property types. You can do it, as I mentioned, on any type of property, single family, multifamily, doesn't matter. As long as it's not your primary residence, you can do a cost seg on it. Apartments, multifamily, typically is around 28% is the average for, which means once we've allocated to land doesn't depreciate. What's left over, we can typically take on average about 28%. Of that will go to faster depreciation. There are certain properties that are going to have more and certain properties are going to have less. For example, like a city type multifamily, what we call in New York, walk-ups, right? Brooklyn, right? Bronx type walk-ups, properties like that. New Jersey, very popular. You have those type of properties where you basically just have like the sidewalk and then the building. There's no land improvements whatsoever. So there's going to be much less benefit from the costing because you're missing out that whole component of the land improvements, which the 15-year, which typically adds a significant component to the cost seg. Strip malls, right? Retail properties are going to be great over 30% typically. Self-storage, also an awesome asset class. Hotels higher up because typically the more furniture and fixture, the FF&E. STR, short-term rentals, also going to be on the higher end. Office buildings typically less because there's just less in there. Warehouses also on the lower end because typically less personal property in there. And then mobile home parks, RV parks, off the charts. This is on the lower end here, but we've seen mobile home parks, RV parks upwards of 70 to 80% bonus of the total property going to bonus depreciation. So the reason why that is because essentially all you own there is the land improvements, right? There's very little structure. And so most properties have structure, and the structure is the main value of depreciation. But a mobile home park, there's going to be very little to structure there. Maybe there's infrastructure like, plumbing lines, electric lines, things like that, sewage, and that'll be on the 27.5 year, but there's no, if there's no structures on the property, then what you own is the land, which doesn't depreciate, but the land improvements, landscaping, the pavement, the concrete pads under each home, right? If you have a playground or you have, the signage, fencing, all that stuff is all land improvements and going to depreciate faster on a higher end. So that takes it for property. And this is not, an exhaustive list here. These are just, certain examples of types of properties and the benefits of cost seg. We do have a case study. I think I'm going to skip the case study just based on time. I'd love to open it up.
But we have time. I'm sorry, I don't know what time it is. What?
8:19.
8:19. Okay, so yeah, we have 45 minutes if you want to go through this.
Oh, okay. Okay, great. Yeah, I didn't realize how much time we have left. Yeah, let's do this this case study. This is a great story, actually, of someone who owned a bunch of single families, sold them all off, wanted to do a 1031 exchange, was not able to do a 1031 exchange. And everyone knows that, or maybe not everyone, but if you don't know, a 1031 exchange allows you to defer the capital gains from the sale of real estate property by taking those properties, exchanging them into, buying new properties. He wasn't able to do it and was left with a huge capital gain tax, over $300,000 capital gain tax. Now, he bought this multifamily property in North Carolina. It was a couple years ago, so that's why you see why it was 1.75 million. So low nowadays, right? It would be much more. So without cost seg, he would have had around $54,000 of straight line depreciation. We did a cost seg, and just so you can see what the benefits were, we took off 15% for land. The 27.5 year, as I mentioned, is the total. The 15-year was 122,000, right? Again, the land improvements. The 5-year property, about 20%, close to 300,000. All in all, his first year tax deduction with 100% bonus depreciation was $421,000. Okay, wow. Which means he had an operating income from this property of about $70,000 or so. What he was able to do is completely, wipe that out. Okay, paid zero taxes on that. Now, again, had he not done a cost seg, he would have already had a $54,000 deduction, so almost wipe out his tax liability from that entirely. But because of the cost seg and the $421,000 deduction, he was able to pay zero taxes and completely wipe out his $300,000 capital gain tax bill. And so that's what we call a lazy 1031. What that means is you don't have to do a 1031 exchange to wipe out your capital gain tax, because if you have enough passive losses from the purchase of another property in the same year as the sale, you could use those losses to offset the gain from the sale of another property. It's not always advised to do it that way. In this guy's situation, that's what he wanted to do. The reason why I say that is because the tax rate for capital gains is typically going to be less than your ordinary income tax rate. And so therefore, to use kind of these deductions that potentially could offset higher tax, rate income is being used to offset lower taxable income or gain. Again, it's not always advisable, but in his situation, it certainly was. He paid, instead of paying $300,000 in taxes, he ended up paying zero. And so that was a huge win for him. And so that's why this is such a powerful strategy, because again, there are different ways to go about using cost seg to maximize what your own personal, business plan is, your own personal business strategy. And so make sure you speak to your accountant and figure out what the best plan for you is. But this was a great story. I remember this. Let's talk about depreciation recapture tax. I mentioned it briefly to Stefan when we were talking about the sale of his property, but this is really important because most people don't talk about this. And what it means is you are taxed on the amount of depreciation taken. Okay, it does not mean that you pay back the depreciation. Big misnomer. A lot of people think, oh, I take depreciation. When I sell the property, I have to pay it all back. No, being taxed on it is a very big difference, right? Think about it. If you took $100,000 of deductions and now on the sale, what's the difference of paying back $100,000 versus being taxed on that $100,000 at 25%? That means a $25,000 tax bill. Very big difference there. Also important to note and I say this a lot, and I'll repeat this to make sure to ingrain this. There is a big difference between being subject to a tax and having to pay a tax. Okay? Being subject to a tax does not mean that you have to pay that tax, because legally there are many ways to strategies to either defer, deduct, or completely wipe out or reduce that tax. So that's why depreciation recapture is so important to understand, because it's not always a bad thing. It can actually be used to your advantage. So there are 3 different rates. I'm not going to go into the complete detail here, but a certain portion of depreciation is taxed at ordinary income tax rate. A certain portion of it is taxed at a max 25% rate. And then there's a third blended rate based on the land improvements component of it. However, there are ways, strategies to use to either defer or offset that. Number one, 1031 exchange. So if you sell the property, you not only defer your capital gain tax, you defer your recapture tax as well. Opportunity zones, this is an amazing tax strategy. I don't know if Ken and Donna, if you've had someone speak about this on your meetup, but it's an incredible tax strategy that also was introduced with the Tax Cuts and Jobs Act back in 2017. And essentially what opportunity zones are, just for a nutshell, every single state has different zip codes that are identified as zones for opportunity to redevelop, essentially to revitalize certain areas of every city, that the government wants to incentivize people to invest in those cities, in those areas, because, frankly, they're kind of lower income or lower places that need revitalization. And so we incentivize people to invest in that. If you invest in that, you can actually defer capital gain tax and actually eliminate capital gain tax if you follow the rules and hold it for a certain period of time. And there are a lot of rules that go into that, but essentially what it says, if you made money, like if you sold anything, okay, if you sold stocks, if you sold bonds, if you sold crypto, and you have this huge capital gain, typically there's nothing you can do about that. Okay, you have to pay that capital gain tax. If you sold real estate, you can use passive losses to offset that, or you can do 1031. But if you sold, stocks, there's nothing you can do about that capital gain tax unless you invest that money into an opportunity zone fund, and then you can actually defer or completely eliminate that capital gain tax. So this is a huge benefit that came about. Great to combine it with cost seg as well, because like I mentioned, it defers, and actually if you hold it for 10 years, that opportunity zone property, then you eliminate any of that recapture tax as well. So awesome opportunity there with opportunity zones. We mentioned already the passive losses in our story of our case study, where the guy used the passive losses from one property to offset the gain from the sale of the other properties. This thing here, partial asset disposition, it's a little bit complicated, but essentially what it says is, once you've done a cost seg and identified every single asset inside the property has a different depreciation schedule. For example, let's say the carpeting has you buy a multifamily property and we identify that there's 7,000 square feet of carpeting, okay, and we value that carpeting at $50,000 through the cost seg. Now, once you've held the property for a few years, from depreciation purposes, after 5 years, there's no more value to that $50,000 carpeting. What that means is, when you sell that building, normally you would pay recapture tax and everything would be included. But since that component and all the other 5-year components no longer have any quote unquote depreciable or tax value, those can be written off through this thing called partial asset disposition, by identifying and saying, well, this carpeting no longer has value. I don't have to pay recapture tax on it because it no longer has any value from a depreciation perspective. That means that when you do a cost seg and combine that with the sale of property, you're not going to be paying any recapture tax on those 5-year components. If you do this thing called partial asset disposition, it's not automatic. It's a special form that needs to be filled. So speak with your CPA how to do this, but it essentially reduces your recapture tax to almost zero for those components. You're still going to have the recapture tax on the building, right, the structures or anything else, but it significantly reduces that. So this is another amazing example to help reduce that recapture. All right, what should you be looking for in a cost seg study? This is really not something that can be done kind of off the cuff. And most CPAs don't do this because you need like this engineering firm. You need someone with the experience. There's a whole, this is taken directly from the IRS's website, the Cost Segregation Audit Techniques Guide, which is basically goes through all the principles that needs to go into a proper, what's called a quality cost segregation study. So there's a whole numbering system. There's a whole methodology. You have to show your work. You have to, bring proofs from the tax code, every single asset and things like that. So it's a very detailed report that is done. Usually our reports are, 100 pages long, great detail. And yeah, so it's not something you can really kind of do on your own. And then a little bit of our company helped save over 4 billion in taxes. Not going to talk too much about it, but really this is the point where I open up for questions because I've covered basically every basic thing there is to know about cost seg. I know there are going to be specific examples and specific details that we can get into more, but like I said at the beginning of this, hopefully everyone should be able to answer the question when someone asks you what is cost segregation, you'll be able to tell them it's a cash flow mechanism that helps you reduce your taxable income by bringing forward accelerated depreciation deductions during the early years of ownership. That's it. So pretty straightforward. I will put my contact info on the screen if anyone does want to reach out or has any following questions. That's where you can find me, yonahweiss.com. I'm very active, as Donna mentioned, on LinkedIn. If you guys are on any social media, whether it's LinkedIn or X or Instagram or Facebook, wherever, please reach out to me. But unless you've already done so, please take 10 seconds and write a little note in that connection, letting me know that you were on this meetup. So, because I'll just get, 100, connection requests or follows of people, and I have no idea who anyone is, right? But I know that you were on this call. That actually starts that conversation, make that connection a little more personal. And that's it. I'm open for questions now.
Right. This is great. If whoever wants to take a screenshot of that, please do. And if you don't mind, we can stop sharing and then, oh, you know what? Maybe you want to refer back to some of those, but all right, let's see.
Yeah, that's fine.
So Stefan, sorry, going back to you.
Yeah.
Do you have other questions now?
No, I'm still processing what he's saying. And I mean, Donna, you know of my account, you know of Bill, and I wrote down Mr. Weiss's suggestions, statements, bonus depreciation, look back study. Can we do any of this without the engineer, or can the accountant say, we never took the bonus depreciation from day one. Can we take it now, even though I sold the building?
Yeah, like I said before, technically speaking, you can. It may be a little complicated how to actually get in the building or whatever for the engineer if to do that meetup. That actual site visit, but yeah, I mean, technically speaking, you could.
Okay. Okay.
So it's interesting you were talking about recapture, because that's something that I was not really that familiar with. So you're saying that if you depreciate, so we're selling a property we've owned 20 years basically. So we didn't have a cost seg done, so we've paid depreciation.
No, we've gotten depreciation.
I'm sorry, we got depreciation, and now when we have to sell it, we're going to do a 1031. But I guess my question is, so let's say you defer taxes into a 1031 and you get another property, not by yourself, but with other people. So is there any kind of weird thing we have to consider in a syndication?
Yeah. Well, yeah, I mean, for syndication, the main thing to consider is who can actually benefit from the cost seg, right? I mean, obviously the general partners typically will be able to benefit from it if they're real estate professionals, but most other people, they're going to be limited to use the cost seg to offset the rental income or the income from the properties or any other investment properties they may have. So there's still going to be benefit there, but if they're not a real estate professional, that benefit is going to be limited. So that's always going to be the first thing to consider.
Okay, so let's say we're not a real estate professional. We can't benefit from the depreciation recapture or the cost seg. I'm just trying to word this, and it's not easy for me to think about it, but the other people, let's say in the syndication, will benefit. So we're not going to get that K1 that says you've got this gazillion, a significant write-off. So is there any, but doing the 1031 is just deferring the depreciation taxes that we
Right.
had to recapture. So at what point then, so let's say you go into a syndication from that point.
Mm-hmm.
At what point do we have to pay back the recapture tax? You know what I mean?
Well,
So we're
I mean,
going
on the
from
sale.
Okay, so we're going from single family to syndication. So when that sells, we either have to 1031 again or pay the taxes, is what you're saying. And
Well, be subject to the tax. Again, remember, being subject to the tax is not the same thing as paying the tax.
okay, subject to taxes.
Yeah, but yeah, anytime there is going to be a a sale without a 1031 exchange, that's when you're going to be hit with that tax.
So what happens if you become a real estate professional like midstream? You weren't a real estate professional, but now you're a real estate professional.
Yeah, it's going to be difficult. Unfortunately, what happens is if you have losses from previous years from doing a cost seg, and you weren't a real estate professional, those are going to be called suspended passive losses, which means that even in the, let's say this year you become a real estate professional, any deductions that you had, that maybe you had like big passive loss carry forwards because you invested in a syndication or whatever, this year you can't even use those losses against your active income because they're what's called suspended passive losses, and it can only be used to offset passive income because when they incurred those losses, you were at a point where you couldn't use them against active income. However, in the year that you are a real estate professional, that's when you can use the deductions to offset any source of income.
Okay, so let's say you sell a property, you're not a passive in real estate, you're not a real estate professional. You go into a syndication, you're not a real estate professional, but the following year you become a real estate professional. So then you can start getting year 2, let's say, depreciation, cost seg depreciation, or because the cost seg was done the year before, you don't get those benefits.
Yeah, unfortunately, like I said, you can still get the benefits, but it's passive losses, which means it's only going to be used to offset passive income or the gain from the sale.
Okay. Interesting. Gets a little complicated. So let me just see who else is here and if there's anybody. So Jeff, I'm going to call on you. I'm sure you have a question.
Oh, right now I really don't. I absorbed a lot of it. I mean, every situation is different, and you always have to go out and ask for help. So right now I'm good, but in maybe 30 minutes I might not be. But yeah, I mean, I just reached out to Yona, so if I have any problems, I will definitely reach out to him.
Oh,
Very
okay.
knowledgeable. It was a great Zoom. I really enjoyed it. Thank you.
All right. Well, I don't want to put I'm usually good for putting people on the spot with questions. So does anybody?
I have a question.
Oh, good. Hello.
Is it possible for you to attain the real estate professional status by, for example, being a GP on like 10 different deals? That way you can get to that 750 hours and not have a full-time job.
Yeah, as long as you don't have another full-time job, I mean, if you are what's called materially participating, you have to have a minimum of 750 hours a
Okay.
year. So, I mean, you mentioned investing in 10 syndications. Well, if those are just passive investments, then there's not really much, you're not going to be a real estate professional for that. But if you do materially participate, if you're a GP or you own rental properties and you manage them, et cetera, then you would be able to do that. But just simply passively investing, unfortunately, without the 750 hours of material participation, you could not be considered a real estate professional.
Yeah.
Okay, I have a question. Uh, I'm a real estate agent. I'm also a tile contractor, and I have my own tile contracting business. So pretty much I fix people's houses, but I also fix some of my own houses, my rentals and such. Would I be classified as a real estate professional?
I mean, at the end of the day, that's a question for your CPA. If you know if
Okay.
they're going to be listing you as that, but it does sound like it. You have a realtor. If you're spending more than 50% of your time in the real estate trader, business, even though you do have another company, um, you know, again, as long as you can show that the majority of your working time during the year is going to be focused on real estate, then yeah, then that's, and really it's about tracking your hours. It's about actually being able to show. If you're ever
Hmm.
audited, if you're ever audited, that's the first thing you're going to look at is you're claiming real estate professional status. Well, show us show us your work, basically show us the time that you spent doing that. And so there's actually a few different apps that have come out over the years. One recently, it's called Reps Log, REPSLOG. You can get in the App Store, and basically you basically just plug in, hey, I did this today. You put it in the numbers, and it saves it all. It's audit proof, meaning it saves it.
Mm.
You can print it out at the end of the year as like a spreadsheet, and it basically tracks any hours that you've done that you're spending on. Hey, today I spoke with a contractor. Today I whatever went to Home Depot to do this. Today I whatever it is, and you
Yeah.
can basically track those hours.
Okay. Thank you.
So can you talk a little bit about the Lou, it's app, no, REPSLOG, the app, right?
Reps log, yeah.
Reps log. I can put it in the chat. App.
Yeah, it's on the end.
So I have a question about the engineer, like what type of engineers? So your company, you're doing development, but you also have engineers on board, and what kind of engineers are they?
Yeah, I mean they're cost segregation engineers. So they focus on specifically doing cost segregation studies. Meaning they've well versed in the tax code and study construction engineering, and so understand how to break down the property into its components and show how each component has a specific value to it, and then be able to depreciate that. So that's really where it comes from.
I didn't even know there was, oh, thank you, Jeff.
What type of cost what would it cost to do something like that?
The cost is typically, it depends on the size and scope of work of the property, but let's say and again, this is right now, single families typically start our company at around $3,000. A bigger commercial property may be upwards of $5,000 or $6,000 or something like that, but not too expensive. We always run a free upfront estimate. So if anyone has a property they're thinking about getting this done, we can run the numbers and show you ahead of time. And so basically for any property, and this is a question actually I didn't mention, but most people do ask, it's one of the most common questions I get, is at what price point does it actually make sense? And so
Yeah.
That was my next question.
there you go. My rule of thumb is typically anything purchased for over $200,000 is already going to be beneficial to do a cost save. It's not as high of a threshold as a lot of people think. I was on a call this morning with a CPA who was like, I never tell anyone to do a cost save unless it's over $1 million purchase. And I was like, well, look at the numbers. Like we just ran an estimate for your guy at a $430,000 purchase, and he's looking at an $80,000, $85,000 tax deduction. Like, why is that
Wow.
not worth it? Like, explain to me why that's not worth it, right? He's like, right. So it's really, I think, a mindset thing, or who knows, maybe just people kind of have a round number in their head, and they kind of go with that over the years.
Yeah. So
Thank you.
on a $200,000 single family, let's say,
Mhm.
can you, I mean, I know it's all going to vary by material and land size and everything, but just
Yeah.
roughly, could it potentially save someone?
Yeah, $200,000. I mean, single family, let's say, there's land to take out. I'd say, on average, you'd be looking about probably like a $40,000 deduction. So it's not huge, right? You're going to pay $3,000 to get it done, get a $40,000 deduction. That means after taxes, you're probably going to be looking at about $15,000 to $17,000 of after tax benefit of cash in your pocket. So again, it's not huge, but it's definitely something. It's worthwhile to look into. That's why I said
Absolutely. Absolutely.
Yeah.
Hmm.
So what else do we need to know about cost seg as a beginner, like as a brand new, somebody who's never done it?
Yeah, I'd say that the most important thing is having an accountant that understands it as well, because you'd be surprised, but most accountants that I speak to have very little knowledge about cost seg, even though it's directly on the tax code. They just don't, they're not, real estate focused. And so they may just not have the niche knowledge that they need to do a cost seg. That's the main thing I would say. Make sure that you have a CPA who understands that.
Okay, do you
I have
need
another question for you. We have 6 single family houses that we've owned for 20 years. Is it way too late to do any cost segregation on that?
I'd say it probably is, because most of the depreciation has already been taken. And so when we
Okay.
do a look back study, we're just looking at how much depreciation is left, how much can we catch up. But since almost all the depreciation has already been taken, there's very little to work with. So
Okay.
yeah, at that point, I wouldn't say it's worthwhile at all.
Okay. Thank you.
But to that point, like what, anything before 5 years would be maybe something useful.
Yeah, absolutely. 5 year is like the sweet spot for sure.
Now, another question for you. When you do a 1031, doesn't the depreciation that you had left on the original property roll into the next one?
That is correct.
So
Yeah,
if
a
you
really
only got
important
like
point.
6 years left, even though you're buying a new property, it would not be, you still would not be, unless you buy something that's like substantially higher in price, would it be to your advantage then?
If you add more capital into the new property, whether it
Yeah.
be your own personal funds or financing,
Okay.
that new money can be depreciated fresh. But as you said, the depreciation basis rolls over from a 1031 into the new property. So yeah, let's say you have your property, for example, you own for 20 years, and there's very little depreciation left. You did a 1031 exchange, you're still left with the same basis. And so wouldn't be beneficial to do a cost seg unless, like I said, you added more capital into the new purchase.
Yeah, because that's what, with our 1031 we might be doing that. We're looking at 2 avenues right now, either industrial or another house. So but we would have to put money into the deal to get us up to what we're selling the house for. So that's why I was asking. Okay,
Yeah.
thank you.
So beside an accountant and hiring like a service like yours who specializes in cost seg, is there anything else we have to consider? Or
I mean, there's probably a lot of other things you can mention, but I think the basics we covered.
all right,
Good.
awesome. All right. Well, does anyone else have any questions, comments, feedback? Want to share?
Yeah, I have a question. This is Haney. How are you?
Oh, Henny, how are you? Welcome.
Good. If you have a building and you are taking depreciation on a 27 years, and in the middle of that time, or after about 15 years, the whole entire building burned, and you reconstruct it again, is the remaining time of the 27 years is the one you have left, or this does it start all over again?
Yeah, really, really interesting question. It depends on a couple of things. So when you rebuild a property, right, then any new money that goes in is going to be depreciated. However, from fresh. However, if that money came from insurance, which is almost always the case, then you cannot depreciate it new.
I see.
Because that's the IRS doesn't claim that as like a new depreciation. It's yeah, unfortunately you miss out. But if you did a costing on the original, then then that's totally fine. But yeah, unfortunately that's happened quite a bit. I've known several cases where that's happened, and it's been a little tricky, but yeah, definitely doable. If it's not insurance that pays for it, you would be able to re-depreciate that.
Great question, though. Great
Yeah.
question. Any other questions?
Mr. Weiss, thank you for your time. Donna, Kenny, it was great. I really appreciated it. Very informative. Thank you, sir.
My pleasure. Thank you all.
Thank you.
Yeah, this was fantastic. So I really appreciate your time, Yona. We thank you. The replay for this will be on our YouTube channel at Look Up with Real Estate. In about a week, I will send you, replay, etc. And stay connected. We have monthly calls. They're deep dives like this one. They're very much geared toward aspiring and early real estate investors. So we thank you for your teaching, for keeping it simple for us, those of us who don't know. All right.
All right, perfect.
And
Yes.
I see you're going to be in Atlanta too in September. I will be there.
I will be. I will be in LA.
15th.
Yeah, I'll be September 15th in Atlanta. That is correct. I will
Yep,
also
and
be
I will be there because that's where I live.
Beautiful.
Yeah,
And if
thank
anyone
you.
is out in Orange County, California, I'll be there on September 9th for a meetup.
Oh,
Great.
all right. So is LA Orange County or San Diego or something else?
You said you'll be in LA. When were you going to be in LA, and
No,
where in
Orange
LA?
County. Orange
Oh.
County.
I'll be in Orange County. Yeah, LA. It's basically halfway between LA and San Diego.
Okay.
He'll be there on September 9th, Stefan.
Okay. All right. All right.
All
Thank
right.
you. All right,
So
bye.
I'm going to end this call, but thank you very much. Oh, wait, there's one question. Can we do cost segregation even if a property is financed?
Yeah, absolutely.
Yeah. All right.
It's even a better reason for doing it, right?
Right.
Yeah, you get more benefit because you're paying less money and you're able to get the full depreciation based on the purchase price, not just how much money you put in.
Oh, somebody wants to book flights for you, Hudson. All right. All right. Well, thank you again. I'm going to stop the recording. We really appreciate your time.
All right.
Thank you.
Pleasure.
Thanks
Thanks for
again.
having me.
See you on
Thank you.
LinkedIn.
Great.
Bye-bye.